Investing in commodities offers a unique opportunity to diversify your portfolio and hedge against inflation. With thousands of years of trading, commodities are also a tangible and historically reliable asset class. On today's program, we'll tell you about one commodity ETF designed to capture income on gold. Plus, we'll reveal the name of a top performing commodity ETF with a 5-star Morningstar rating. Stick around for that. I'm Thalia Hayden with ETF Guide. It's great to see you again. Before we go any further, just a quick reminder that Spotlight is available on major video streaming platforms like Apple TV, Amazon Fire, and Roku. Plus, you can find us on major podcasting platforms like iTunes and Spotify. Using commodities in your investment strategy can potentially enhance returns and manage risk, along with allowing investors to capitalize on the supply and demand dynamics that drive their value. Moreover, ETFs linked to commodities offer an easy and affordable way to access this core asset class. Here to discuss that and more is John Love, CEO at USCF Investments. Hi, John. Welcome to the show.
Hi, Thalia. Thanks for having me.
Good to see you. Let's begin. S&P Global projects that worldwide copper demand will double, reaching approximately 50 million metric tons by 2035. The United States Copper Index Fund, ticker CPER, is one way to invest in this megatrend. So what's driving copper demand, and why should investors pay attention to this?
Well, the world needs copper. The world's only going to need more copper, as you said. There are so many infrastructure, manufacturing, industrial uses for copper. It's in everything: your phone, your car, your house, your office building, the power grid that makes everything we do in modern life possible. So it's just huge. It's probably becoming even more important than a lot of other commodities historically, just because of its need for in new applications like AI data centers and in electrification of cars and the electric grid. All of this build out requires more copper. But the key thing here is that over the last few decades, actually, there has not been enough investment in new copper supply. So the copper miners, they're doing their best to put out, to try to meet demand that's there right now. But with this undersupply or this underinvestment over the years, it's difficult. There was just a story today. Codelco is having trouble meeting demand, and that's just going to continue. So This is huge. This is why you see stories on the news about catalytic converters being stolen and wire spool and people climbing utility poles, and it's going to get more intense as copper supply kind of falls under the increasing demand over time.
Wow, interesting stuff. The USCF SummerHaven Dynamic Commodity Strategy, no K1 ETF, ticker SDCI, is a 5-star rated Morningstar ETF. It's delivered top performance versus other commodities ETFs. What's contributed to SDCI's success, do you think? And how might a fund like SDCI be deployed by financial advisors and investors?
Sure. Well, we think SDCI, one, is a core commodity holding. If you are wanting to allocate to commodities, it provides you that broad allocation that you get from well-known indices, but it's dynamic, and that's the key to what it does. It doesn't hold every commodity at the same time. It does hold one commodity in every sector, and it does give you that broad allocation, but it only holds 14 out of about the 28 most liquid commodities in the world every month. And it equal weights those and rebalances every month. So what we're doing is using a signals-based approach to pick commodities that we basically think more likely to do better than the commodities that we don't pick. And that process has worked out really well. Over the last 3 years, the annualized return has been about 15% versus 3.5% for the Bloomberg Commodity Index, which is a broad benchmark. This year to date, we're up 9%, whereas BCom is about flat. So that dynamic process is really key to what's going on. So it's there for people who want an allocation to commodities, but instead of just sitting in everything or maybe overweighting something, we're dynamic, we equal weight, we're looking for opportunities in the commodity space wherever they are.
That definitely makes sense. Now, oil and gas prices have risen since the start of the year, and the United States Gasoline Fund, along with the United States Oil Fund, ticker USO, are both easy ways for investors to participate. So, what's behind the move in oil and gas prices, and do you think it'll continue?
So global demand has been strong, not off the charts, but it's been very good. Growth has been good, certainly coming out of COVID over the last few years, and that's continued. But the key thing has been that OPEC has had quotas in place for about 2 years now, and certain countries like Saudi Arabia within OPEC have agreed to voluntary cuts. And so they've held down the price of oil. They've tried to manage that supply below demand, even as other producers like the United States, as our output is rising. So the key thing has been OPEC. Now, can it continue? They basically announced on June 3rd that they're going to start unwinding those voluntary cuts over the next 12 months, starting on September 1st. But they've been very clear that they can change their posture based on data. So they're very keen on keeping a floor on that price. Where it is, I'm not entirely sure, but maybe $65, $70, somewhere in that range. So they could change course if the data warrants it. And in the meantime, we'll see what happens with supply. I think one of the key things that's on people's minds right now is politics and what happens if the Republicans win a majority of the government, the presidency, the Congress. We're hearing drill, baby, drill. What does that do? And the thing is that the U.S. producers are already drilling. They've gotten much more fiscally responsible. They have increased output quite a bit. They can increase it more, but I don't think that's going to be as big of impact as people think. So I think the key thing is to watch OPEC, see if they continue to support the price. They essentially have a put in place, just like we have the Fed put. And as long as their policy is managing price and not market share, then I think the market is healthy and will at least see support for prices. The last thing I'd say is, one thing I don't think is enough is priced in enough is the potential for a geopolitical shock. Certainly, there's some risk priced in for Ukraine and things going on in the world like that. But if something happens big, you could see prices really skyrocket if, say, the Strait of Hormuz was shut down or something like that. So those are two things I would encourage people to watch.
We'll keep an eye on that. Got it. The USCF Gold Strategy Plus Income Fund, ticker USG, enables investors to have exposure to gold while earning some income. Now, that's a unique feature because gold doesn't have earnings or pay dividends. Can you tell us more about USG's unique investment income strategy on gold and what type of investor USG might appeal to?
They would appeal to investors who love gold, want a gold allocation for safety or diversification, but they wish their gold investment gave them income, like you said. And this fund does that. And the way it does it is we hold gold futures. We can take delivery of on those futures of gold warrants, which are similar to the warehouse receipts that physical gold ETFs have. But the key thing is we sell covered calls on our gold positions. And that's what earns the options premium that allows us to distribute income. And the trade-off here is that means that in the short term, you could see price fluctuations relative to the price of gold or maybe a traditional gold ETF. But over the long term, these kind of strategies tend to outperform. So it's kind of for the investor who, I don't mind short-term fluctuations. I don't mind if it underperforms a little bit here. I'm more into this for the long run. I want to be exposed to gold, but I want to earn some income too. And this has done well. The 12-month yield has been 6.9% on USG for the last 12 months. So we think it's something investors might want to consider if they're into gold.
All right. And one final question before you take off, John. Some investors may want to invest in commodities, but with the guidance of portfolio manager, that's where the USCF Energy Commodity Strategy Absolute Return Fund, ticker USE, can be deployed. So can you tell us more about USE's unique investment strategy?
USE, which I call USE for short, or to make it easy. USE is, I think it's unique. It was developed based on our many years of running passive energy investments. It's systematic, so it just follows a rules-based system. But what it's designed to do is to work in all market types. So we're not trying to pick tops or bottoms. When the market's trying to figure out, its direction, it might not perform as well. But what we're trying to do is perform well when the market's going up, energy markets are going up, sideways or down over the long term. And so far, it's met our expectations. It's had, as of last night, it was up 28% versus 14% on the S&P, and about 15% for a long-only investment in oil. So we're almost double both of those things. And back to the BCOM energy index, that also has been pretty flat for this year. So it's meeting our expectations so far. And it's just that systematic process. It owns futures contracts like our other funds, but it can go long, short, or take spread positions. And it adjusts in real time. And we think it's something that investors might want to look at. The last thing I'd say on that is it does have higher volatility than something like the S&P 500, but it's designed to. And that volatility actually helps you when you're looking to add an uncorrelated asset, because that extra volatility in an uncorrelated product lowers your overall portfolio volatility. And that's exactly what it would have done if you added it to the S&P 500 this year. Even 1, 2, 3, 5%, it would have boosted your return and lowered volatility somewhat. So we're very proud of that product.
All right, John, thanks so much for dropping by and helping us stay on top of the latest market trends. We really appreciate it. Keep up the great work.
Thank you very much. Appreciate it.
And that'll do it for today's episode of Spotlight. If you enjoyed the show, tell us in the comments section below, please, by hitting that like button. To learn more about the investment strategies and ETFs we discussed on today's program, be sure to visit USCFinvestments.com. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.